Daily stock market update, slightly different at the moment for obvious reasons. Let's look at the S&P 500. Where are we? Now, for those of you who are familiar with my work will know that I describe market falls into three categories: baby bear, mummy bear, daddy bear. Now, you might think, well, silly. Well, actually, this game is all about communicating things clearly, and Goldilocks is how we often explain the economy. Certainly, central banks say we're in a Goldilocks economy if inflation is not too hot or growth is not too hot and not too cold. So what do I mean by a baby bear? Baby bear, very simple. Prices are falling, but the average short and medium term prices as shown by the monthly MACD, which is a moving average of prices, the green dotted line over there, is not falling. Okay, you can see the green dotted line for clarity over there. That's called a baby bear. That can become a mummy bear. And by the way, baby bears, 3 or 4 in a year. Mama bear, maybe 1 a year. And that is where prices are falling, as they are at the moment, as you can see over here. And so is the MACD, or moving average. And a daddy bear is where there's a crossover between the green and the blue line. The blue line is the moving average of the averages of the prices. So it's a little bit slower to react. And the issue for people at the moment is, well, where are we? Well, we're in what's called a mama bear. Now, will that become a daddy bear or not? And what should we do? So you've got several options: buy, sell, or hold, of course. Would you buy more? I tend never to buy more if the monthly average prices are falling. Very simple. So I would rather tend to wait. Okay, unless I'm buying a portfolio for, let's say, 1, 2, 3 year hold, and I'm in a bit of a rush and I think, do you know what, just need to get on with it. Boom, get the portfolio done. But under normal circumstances, don't tend to buy when it's falling like that. We see that this is going to happen. Well, for a long time now, I've been saying that this pattern is very similar to the pattern in 2025 and in 2021. That doesn't guarantee something's going to happen. You can't guarantee anything in the markets. If you could, you would own all the money in the world. It's all about probabilities. So whilst there was an increased probability of what is happening now would happen, and when I used to do my Bloomberg TV show, we'd always say, well, in hindsight, everything was obvious. But in foresight, there was an increased probability, and indeed, it has happened, or is happening in front of us. So what do we do? Well, like I said, I wouldn't buy. Would I continue holding? Well, what are the dangers of continuing to hold? Well, if you hold and it keeps falling, as it did last year, then you're going to get an ulcer. The ulcer index is measured by the depth of fall and the duration, the speed at which the fall happens. A 30% fall, which happens over 3 years, is not going to give you the same ulcer as a 30% fall, which happens overnight, in other words. So depth of fall and duration within which it happens, that's your ulcer index. So if you're risk averse and more prone to getting ulcers and you see a mama bear, you're probably more inclined as it progresses to start selling and getting out of the market. What's the danger of that? The danger of that is you get a quick V-shaped recovery. You've sold some positions. You end up buying back more expensive later. That's your cost of insurance. And of course, there's a cost to your time and executing incorrectly. Those are all very real threats, which therefore brings us not to selling, but then the third option, which is to buy. Which is to hold, which is hold and do nothing. So if we get to this third option, which is to hold and do nothing, what are the pros and cons of that? Well, first of all, if you hold and do nothing, you get the fall, you get the ulcer, but you haven't bought back more expensive later because you didn't sell. Okay? And therefore, not a problem. All seems positive, doesn't it? As long as you can suffer the ulcer. Well, here's what happens on the downside, because every one of these decisions has a pro and a con. And the downside of holding and doing nothing is it could be a prolonged fall. Now, the daddy bears happen once every 3, 4, 5 years, so lower probability. And on a daddy bear such as this, you, of course, are more likely to get the ulcer because the falls tend to be deeper. Okay? And you suffer from boredom as well. So you get the ulcer plus the ADHD starts kicking in. And of course, it means that if you had sold earlier and bought back cheaper, you'd have a bigger return to the upside, whereas you've held, therefore you miss out on the bigger return. So you can see the pros and cons of each approach. If you buy more, you're taking more risk because the MACD is falling. If you hold, then you have the benefit of not having to buy back more expensive later, but you have the cost of the danger of a prolonged fall. And we don't know which one of these outcomes is going to happen, except we do know historic probabilities are that markets over the long term tend to rise. Daddy bears happen once every 4 or 5 years, and mama bears happen 3 or 4 times a year. So you might take your chances on the probabilities and say, you know what, I'll sell a bit of position, but not all of it. Again, the danger with that is you mistime the executions, you still kick yourself. But I thought I'd lay it all out for you. Now, if you want to do the things instead of what I've said and try and get things perfectly, but in terms of what's the easiest to do and what's the hardest, the easiest to do is do nothing, self-evidently. The hardest to do is to say, well, I'll get out now. I won't have any FOMO or regrets. And should the market rally, then I'll just end up buying back more expensive later. But at least I'll be happy that I'm out. So what you've got to try and do is optimize for your personality type. Which one of those are you? And you don't truly know yourself until you live through it. Okay? Those who think they can time often don't do it. They mess it up. The old saying about time in market, not timing the market. Those who buy and hold end up getting 0% returns for a prolonged period of time because they didn't exit and therefore they didn't buy cheaper. And whilst the rest of us were riding the upward cycle, they were still having nothing. But they're happy, presumably, doing that. Those who try and have half in each camp mess up the first bit and end up being unhappy with everything. Now, if any of that sounded complicated, don't worry, move on. Markets look like they're going to fall a bit longer, but overall, they tend to go up. Don't do anything. Okay? Because if you find that complicated, then obviously don't do anything. Okay, so I hope that keeps it simple being for those who want simplicity. Do nothing, but be warned, you may have falls. Get ready for the ulcer. Overall, the good news for you is the markets tend to rise over the long term. You might make less than somebody who's timing, but don't feel FOMO because you're not trying to keep up with the Joneses. What they do is none of your business. For those who do try and time it, well, at least you're being proactive and you've got ambition. I hope you get it right, but be warned, you might buy back more expensive. Okay? And those who think now's the time to buy the dip, whoa, well, maybe try sword juggling as well. Okay? Hopefully you found that helpful. If you did, have a look at campaignforamillion.com. Lots more free education there on the markets. Thank you.